If you want to understand the most dangerous economic environment for an ordinary family, do not start with the word recession. Recessions are painful, but at least they are familiar. People know what a recession feels like. Sales slow down, jobs become harder to find. The newspapers grow dark, the Federal Reserve cuts rates. Bad businesses get exposed. Good businesses usually survive, time and discipline do the rest. The environment I worry about more is the one that confuses almost everybody at the same time. It is the moment when growth goes soft, jobs get shakier, and prices still refuse to behave. It is the moment when your paycheck feels lighter every month, not because you stopped working, not because you became careless, but because the economy has found a way to punish weakness and prudence in the same season. It is the moment when the medicine for one problem feeds the other problem. Raise rates and you risk breaking demand. Cut rates and you risk feeding inflation. Spend more and you may stabilize the system for a while, but you may also pour gasoline on prices. Spend less and you may calm markets in one corner while making unemployment worse in another. That setup is uglier than a recession because it robs policymakers of clean choices and robs families of clean shelter. I have spent most of my life studying what happens when markets become simple enough for people to believe they understand them. Usually that is when the danger starts. A bull market makes people think growth is permanent. A crash makes people think opportunity is gone. An inflation scare makes people think cash is trash. A deflation scare makes people think every asset is poison. But the hardest periods are the mixed periods, the periods where the signal is muddy, the pressure is real, and the usual playbook starts giving contradictory answers. That is the kind of period many people are staring at now without yet admitting it. When I hear the word stagflation, I do not hear an academic term. I hear three pressures arriving in the same room and refusing to leave. I hear stagnant growth, softening labor, and persistent inflation. I hear households losing ground in three directions at once. I hear business owners facing weaker customers and higher costs. At the same time, I hear a central bank forced to choose which wound to treat first, knowing the treatment may deepen the other wound. Most investors are not built for one storm that blows from two directions. They are built for a slowdown or for inflation. They are built for weak earnings or for rising rates. They are built for one explanation at a time. What they are not built for is an economy where the grocery bill climbs, the job market weakens, long-duration assets get repriced, and the people in charge no longer have an easy tool that fixes the problem without worsening another one. That is why this kind of environment deserves respect. The first consequence is brutally ordinary. Your money buys less while your confidence shrinks faster than your account balance. People tend to think loss is something they see on a brokerage statement. That is only one kind of loss. Another kind of loss happens at the gas station, at the grocery store, on the power bill, in insurance premiums, in property taxes, in every small monthly obligation that does not make headlines on television because it arrives quietly and repeatedly. Inflation is not only a number reported by economists. Inflation is a behavioral tax. It changes how families live. It changes what gets delayed. It changes which repairs wait. It changes when people stop going out. It changes the kind of food they buy, the distance they drive, the risks they take, the way they talk to each other at the end of the month. The second consequence is even harder because it strikes identity, not just arithmetic. When businesses begin protecting margins, they do not hold committee meetings with families. They freeze hiring. They cut overtime. They postpone expansion. They reduce contractor budgets. They ask one employee to do the work of two. A labor market does not have to fully collapse before households feel fear. Fear arrives much earlier. Fear arrives when people sense the next opportunity is narrower than the last one, when the recruiter stops calling, when the extra shift disappears, when the company starts using words like efficiency, discipline, right-sizing, optimization, and strategic review. The third consequence is the one that investors usually underestimate because it does not show up in a single price chart. It is the policy trap. In a normal inflation problem, the central bank can lean harder. In a normal employment problem, it can get easier. In a normal recession, rates come down and the relief itself becomes part of the cure. But in this setup, the hand on the thermostat is attached to two different systems. Cool, one room and the other room starts overheating. Warm, one room and the first one starts fogging up again. That is what makes this environment dangerous. It is not only that inflation is stubborn, it is that the authorities no longer possess an elegant response. That is the part people do not price properly. until it is already expensive. When investors are spoiled by cleaner cycles, they start believing there will always be a rescue that resembles the last rescue. That belief creates laziness. If growth rolls over, the Fed will save us. If markets fall, rates will come down. If earnings disappoint, liquidity will arrive. The trouble in a stagflationary setup is that liquidity can become part of the disease. Relief may support asset prices for a while and at the same time weaken the purchasing power of the people trying to live inside the system. This is why I say something worse than a recession can be brewing. A recession at least gives you a cleaner villain. This environment gives you 3 villains and lets each one wear the other one's clothes. Now let me tell you where these pressures come from, because nothing in economics becomes useful until you can name the mechanism. The first mechanism is what I would call the tariff inflation loop. A tariff always sounds distant when politicians announce it. It sounds like a border event, a policy event, a corporate event, but tariffs rarely stay where they are first imposed. They travel, they move through the chain, they are paid at one point, repriced at another point, absorbed for a time by a business, then pushed forward into final prices when margins get too tight to pretend otherwise. Some businesses swallow part of the pain, many pass it through. Households end up paying for the politics in installments. That is why tariffs are not only a trade story, they are a consumer story. And what makes this loop more dangerous is timing. The bill does not always arrive on the same day as the policy. That delay creates false comfort. People assume the impact was exaggerated because they do not feel it instantly. Then months later, the pressure appears across categories that seem unrelated. The costs of imported components creep into durable goods. The transportation bill moves. Supplier negotiations get reset. Price increases that look temporary begin settling into the furniture of the economy. By the time households realize they are paying, the debate has usually moved on to another subject. The second mechanism is the energy shock. High energy costs are among the purest ways to spread inflation through an economy because energy sits underneath almost everything. It powers transportation, it drives manufacturing, it influences fertilizer, packaging, shipping, heating, cooling, commuting, distribution, and margins. When oil prices stay elevated, they do not merely make drivers angry, they work like a tax on the entire system. And here is what makes energy shocks so vicious. They do 2 things at the same time. They push prices upward and squeeze discretionary spending downward. Families pay more for necessities and therefore spend less on everything else. Businesses pay more to operate and therefore become more cautious about labor and investment. Inflation moves one way, growth moves the other way. That is textbook stagflationary pressure. And it does not need a theory to hurt people. It only needs persistence. The third mechanism is the central bank conflict. If the labor market shows cracks, pressure builds to cut rates. If core inflation stays sticky, pressure builds to hold firm or even tighten. Either move offends somebody, either move carries a cost. The longer inflation refuses to return to a comfortable level. While growth deteriorates, the more the Fed stops looking like a surgeon and starts looking like a man trying to repair a roof while the basement is flooding. Markets hate that kind of uncertainty because valuation is easier when the discount rate is falling cleanly or rising cleanly for a reason everybody accepts. It gets much harder when the direction of rates itself becomes part of a political and economic argument. The fourth mechanism is structural fog. This is where the future promised by technology collides with the present reality of costs, labor, and uneven adoption. Every cycle creates a new story powerful enough to attract capital before it has fully earned the right to absorb so much of it. A few years ago, many people treated the next phase of artificial intelligence as though it would instantly convert potential into broad productivity. In the real world, adoption takes time. Integration takes time. Cost savings do not appear in the same quarter that enthusiasm appears. New tools can be transformative and still fail to rescue margins fast enough to matter in the period, when labor, financing, and materials are already under pressure. The market is often impatient with the middle distance between invention and payoff. Investors hear a revolutionary story and price the ending before the plumbing is installed. At the same time, demographic pressure makes the picture more complicated. An aging population changes demand patterns, retirement patterns, healthcare costs, labor availability, and the tax base. Shifts in immigration change labor supply in certain industries. even while weakness in other sectors lifts unemployment. The result is not a clean story of abundance or scarcity. It is mismatch. And mismatch is another word for friction. Friction is another word for cost. Cost, sustained long enough, becomes inflationary pressure. The fifth mechanism is fiscal strain. This is the one people like to discuss only when it flatters their politics. I prefer to discuss it when it affects arithmetic. When debt service rises toward the economy's growth rate, the government loses room to maneuver. Stimulus becomes harder to use without consequences. Borrowing more to solve one problem can intensify the next. A nation can carry a great deal if productivity is strong, policy is credible, and investors trust the currency. But when inflation is already sticky and growth is already vulnerable, large fiscal moves stop looking like free options. That is when the menu narrows. And whenever the menu narrows, the margin for policy error becomes much smaller than people think. This is the point where many investors make the same mistake. They hear a difficult macro story and assume the intelligent response is to predict the exact path of the economy. I have never believed the ordinary investor gets paid for precise macro prophecy. The better question is not, can I forecast every turn? The better question is, what kind of portfolio survives if the turn is uglier and slower than consensus expects? That is the right question because stagflation punishes the wrong kind of confidence. It punishes blind duration. It punishes business models that require cheap capital and perfect sentiment. It punishes people who own future promises as though those promises are present cash. It punishes portfolios built on the assumption that the valuation multiple will always come to the rescue if the narrative is exciting enough. If you think about it plainly, high rate sticky. Inflation environments are difficult for long-term bonds because the fixed cash flows become less attractive as prices and yields move against you. They are difficult for high, multiple growth stocks because a distant dollar is worth less when the discount rate is high and uncertain. They are difficult for speculative businesses because capital gets more selective exactly when margins are most fragile. That does not mean every growth stock is doomed or every bond is foolish. It means the burden of quality rises. The asset mix that tends to behave better in this type of environment is not magical. It is simply more grounded in present cash flow, present utility, and real pricing power. Real assets matter more. Businesses that sell what people must buy matter more. Shorter duration instruments matter more. Value matters more. Optionality matters more. Liquidity matters more. The ability to absorb inflation instead of being silently eaten by it matters more. This is where people start talking about protection, and protection is often misunderstood. Protection is not about making heroic bets against civilization. Protection is not about panic, buying whatever has gone up recently. Protection is not about turning a portfolio into a bunker. Protection is about reducing the number of ways you can be ruined by one environment. Commodities are part of that conversation because they tend to rise when input prices rise. They are volatile. They are not pleasant assets to own emotionally. They can go nowhere for long periods and then suddenly matter very much. But in inflationary pressure, they can behave like a release valve energy. Metals, agricultural exposure, these are not sentimental holdings. They are economic instruments tied to the real world. Gold belongs in this conversation for a similar reason, though I prefer to speak carefully about it. Gold does not generate productivity. It does not build railroads or sell insurance or compound retained earnings by itself. But it has one enduring feature that humans rediscover whenever they lose confidence in paper promises. It sits outside a great many systems in a period where people fear currency debasement or policy error more than they fear boredom. Gold often regains a kind of respect that looked old-fashioned only a year earlier. Real estate also belongs in the conversation, but with an important qualification. People talk about real estate as though it is one thing. It is not. There is a difference between a sensible property bought at a sensible price with sensible financing and a leveraged trophy bought on the assumption that appreciation will do all the work. Physical property has the advantage of tangibility. Rents can adjust, land cannot be printed. Good assets in good locations often preserve utility even when markets become confused. But leverage can turn a good real asset into a bad financial asset if rates, vacancies, taxes, insurance, or refinancing conditions move against the owner. So when I say real estate can help, I mean disciplined real estate, not fantasy. Defensive equities matter because the world keeps buying certain products regardless of whether economists are cheerful. Utilities still keep the lights on. Healthcare is still needed. Consumer staples still move off shelves. These businesses are not glamorous. And that is often their advantage. They tend to have steadier demand, and the better ones can pass through costs without losing their customer base. In difficult periods, boring can be beautiful. Value stocks matter for an even simpler reason. When a company has real earnings, strong cash flow, pricing power, and a valuation that does not require ideal conditions to justify itself. You begin the game with a margin of realism. I did not say certainty. I said realism in a market intoxicated by promise. Realism can look old. In a stressed market, realism starts looking like leadership. Inflation-linked instruments matter because they acknowledge something most savers hate admitting. Nominal safety is not always real safety. If inflation stays elevated, a fixed return can leave you poorer in purchasing power even while your statement appears calm. Instruments designed to adjust with inflation help preserve what matters most, not just the number, but what the number can still buy. Short-term treasuries matter because they keep duration under control and give you flexibility. In a difficult macro environment, flexibility is underrated. The investor who can roll shorter maturities, reassess conditions, and avoid being handcuffed to a long, low fixed return possesses something. The long-duration holder may envy room to think. Liquidity combined with yield is not exciting in a bull market. It becomes very exciting when the world gets confused. And then there is the issue of excessive growth exposure. Now, I want to be careful here because many people hear caution and translate it into renunciation. I am not telling a 30-year-old to fear every innovative company or to build a portfolio only for next quarter. Time remains a tremendous ally. Productive businesses remain the engine of wealth. But there is a great difference between owning excellent businesses for the long run and crowding into whatever part of the market is most dependent on low rates, perfect sentiment, and endless narrative reinforcement. If you are decades from retirement, volatility is a partner you can survive, perhaps even welcome. If you are 5 years from retirement or already living off your portfolio, volatility becomes something else. It becomes sequence risk. It becomes lifestyle risk. It becomes the difference between drawing income from assets that are holding up and liquidating assets that have been repriced at the worst possible moment. That is why portfolio construction is not a morality play. It is a timing play mixed with a temperament test. The same asset can be perfectly sensible for one person and reckless for another. I have often said that the stock market is a device for transferring money from the impatient to the patient in a stagflationary environment. I would add another line. It also transfers money from the undisciplined to the prepared, because this environment exposes hidden fragility. It exposes investors who were counting on one outcome and built no backup path. It exposes households that own only long promises and very little current resilience. It exposes people who call themselves diversified because they own many tickers that all depend on the same macro condition. A real portfolio should not be built like a vote of confidence in one single future. It should be built like a bridge, different supports, different spans, different materials, one part built for inflation pressure, one part built for durable cash flow, one part built for optionality, one part built for long-term compounding, one part built for immediate stability. The point is not to eliminate uncertainty. The point is to make uncertainty less capable of wrecking you. Let me make this more personal because economics becomes useful only when it leaves the television and enters the living room. If I were sitting at the kitchen table with a family trying to think clearly in this environment, I would tell them not to begin with forecasts. I would tell them to begin with exposure. How much of your life is exposed to rising essentials? How much of your income depends on a job market that is starting to soften? How much of your portfolio depends on falling rates? How much of your net worth depends on expensive growth continuing to be loved by the market? How much cash flexibility do you have if prices stay high longer than expected? How much debt do you carry that becomes more uncomfortable the longer rates stay elevated? Those are not dramatic questions. They are adult questions. They are the questions that convert macro fear into household action. Then I would tell them to perform a second test. I would ask which of their assets produce something useful. Right now, which holdings generate current cash flow, which companies possess pricing power, which instruments preserve liquidity, which obligations are fixed and manageable, which exposures are there because they fit a plan, and which are there because they were fashionable. Markets have a cruel way of revealing who bought because they understood, and who bought because everybody else seemed to be making money. In easy times, both groups look smart. In difficult times, only one group remains standing without having to explain themselves to the mirror. This is also where I would remind people that protection does not have to be perfect to be valuable. You do not need to guess the exact path of oil. You do not need to know the exact month inflation peaks. You do not need to predict the next Fed meeting with theatrical confidence. You only need to avoid being structurally wrong in too many places at once. That means reducing obvious mismatches. If your bond exposure is extremely long while inflation is still sticky and rate uncertainty is high, ask whether that is wisdom or inertia. If your equity exposure is overwhelmingly concentrated in high-duration growth names because that was what worked before, ask whether you own a strategy or a memory. If you have no allocation to real assets, no inflation, sensitive instruments, no defensive cash flow, and no meaningful liquidity, ask whether your portfolio is prepared for complexity or merely hopeful that complexity will go away. Hope is not a portfolio strategy, not in any environment. Certainly not in this one. There is another mistake people make in periods like this. They become so frightened by the macro picture that they stop investing altogether. That is also a form of surrender. The answer is not paralysis. The answer is adaptation. Rebalance with intention. Own quality, shorten duration where appropriate, respect valuation. Favor businesses with cash flow over businesses with slogans. Favor resilience over story. Favor pricing power over popularity. Favor liquidity over ego. If you do that, you do not need to win every month. You only need to avoid being the person who built a portfolio for a world that no longer exists. And that, in the end, is what makes this setup so dangerous. Not simply that inflation is stubborn or that growth is weak or that policy is trapped. The danger is that many people are still arranged for the previous decade. They are still arranged for zero-rate thinking, for endless multiple expansion, for cheap debt, for growth at any price, for the belief that the market will eventually reward optimism even if the cash never arrives. This period asks for a different temperament. It asks for patience without passivity. It asks for caution without cowardice. It asks for realism without despair. It asks investors to think not like speculators chasing the fastest story, but like owners protecting future purchasing power. That phrase matters more than most people realize. Purchasing power, not headline returns, not the temporary pleasure of outperforming a neighbor in one hot quarter. Purchasing power is the real scoreboard because purchasing power decides how you live, what choices remain available, what burdens feel manageable, what surprises can be absorbed, what future can still be financed. A portfolio that rises 6% while inflation devours 5% and taxes take another bite may look alive and still leave the owner weaker. A portfolio that compounds more modestly but protects real spending ability can quietly win the only game that matters. So if you ask me what to do when something worse than a recession may be forming, I would say this. Do not chase a grand prediction. Do not hide in slogans. Do not assume the old rescue will arrive in the old form. Do not build your family plan on the idea that policymakers can solve a three-headed problem with a one-handed tool. Instead, start naming your vulnerabilities. Start shifting your exposures. Start favoring assets that can live in a world of persistent costs, uncertain policy, and slower growth. Start acting like inflation is not a headline but a condition. Start acting like liquidity is not laziness but optionality. Start acting like defensive cash flow is not boring but valuable. Start acting like long-term compounding works best when you first survive the part of the cycle that humiliates unprepared people. This kind of environment does not ring a bell. It does not wait for investors to get comfortable. It arrives gradually and then all at once in behavior. Families spend differently. Businesses hire differently. Markets price differently. The central bank speaks differently. Politicians blame each other more loudly because the choices themselves have become worse. That is when you discover whether you own a portfolio built for applause or a portfolio built for endurance. I would rather own endurance every time because eventually this period will pass too. Every ugly setup does. Inflation breaks or growth heals or policy regains room or valuations get cheap enough to create their own future returns. But the people best positioned to benefit from that next chapter are usually not the ones who denied the pressure in this chapter. They are the ones who kept their footing, while others kept arguing about whether the floor was moving. That is why I do not treat this as a time for panic. I treat it as a time for seriousness. Seriousness about debt, seriousness about duration, seriousness about the difference between a great business and an overpriced stock, seriousness about real assets, seriousness about defensive cash flow, seriousness about preserving the ability to act when markets make acting emotionally difficult. You do not have to know exactly how bad it gets. You only have to know that environments like this punish laziness and reward preparation. And if you prepare with discipline, not drama, you give yourself something most people will not have. If this setup deepens, you give yourself room to hold, room to buy when others are forced to sell, room to pay your bills without liquidating your future, room to think clearly when fear becomes fashionable, room to treat economic difficulty not as the end of your plan, but as the proving ground for whether you ever had a real plan at all. That is the final test. Not whether you can sound informed about stagflation, not whether you can repeat the right buzzwords at dinner, not whether you can predict the next policy mistake before the television does. The real test is whether your money is arranged for a world in which growth slows, prices stay stubborn, and the people in charge cannot rescue everyone quickly. If the answer is no, then this is the time to change it. If the answer is partly, then this is the time to strengthen it. If the answer is yes, then this is the time to stay disciplined, while everybody else rediscovers that economics is not a game played on screens. It is a force that enters homes, businesses, paychecks, retirements, and choices. And in a period like this, the people who come out strongest are not the loudest, not the boldest, and certainly not the ones pretending nothing has changed. They are the ones who saw the trap early enough to stop walking deeper into it.